On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, let's take a look back at last week, then we'll turn our attention to what is coming up. Global share markets, bit of a mixed bag last week. In the United States, we saw the S&P 500 index rise another 1.6%, so another very good week. The market hit new highs in the process. Investors were encouraged by a softer than expected inflation report for May, and we also had the Federal Reserve meeting, which we'll talk about soon. In contrast, European shares fell 2.8%, fresh political uncertainty over in Europe. Elsewhere, we had the ASX 200 across the Tasman down 1.7%. The FTSE 100 in the UK was 1.2% lower. And Japanese shares were little moved, emerging market shares little moved, and the local NZX 50 also very little moved. Now, all the action was in Europe last week. French President Macron took everyone by surprise, even some members of his own party, when he called snap elections following his party's heavy defeat in the European parliamentary elections. And that defeat came at the hands of RN, which is the biggest single opposition party led by Marine Le Pen. I can't remember what RN stands for, but this party used to be called National Front. That's what many listeners would remember them as. So a heavy defeat for Macron's party. And that's why he's called those snap elections. Now, these didn't need to happen for some time. France normally holds elections every 5 years. So the next ones weren't due until 2027, although we're now going to see those in a couple of weeks' time. And French elections take place in 2 rounds. So you get a first round and a second round. The first round will be on the 30th of June, so the end of this month, and then the second round will be on the 7th of July. This news did see a risk-off tone reverberate across European markets, particularly in France, but elsewhere too. Share markets fell, investors took refuge in safe haven assets like bonds, like gold, like the US dollar. French bonds were sold off because investors demanded a higher premium to own that French debt. So the spread between French and German yields widened to the largest since early 2020, and German yields actually declined a little bit. So that was seen as a safe haven, and people were much preferring German bonds rather than French bonds. So a bit of political action over in Europe, and that did really set the tone for a tougher week for European assets, particularly shares and risk assets. Interest rates elsewhere, the US 2-year Treasury yield fell from 4.9 to 4.7%. The 10-year yield finished lower too. It finished at 4.2%. That's the lowest in more than 2 months. Here in New Zealand, it was a similar story. Our 5-year swap rate fell 8 basis points, finished the week at 4.4%. That's the lowest since early April. A range of factors drove that. A lot of it was about that US inflation report and then the Fed meeting. But here in New Zealand, we also got the selected price indexes for May. These came out on Friday, and they do give us a bit of a steer about where some parts of the CPI inflation basket are headed. And this report for May was weaker than expected. So that bodes well for the path of inflation in the June quarter. It can be volatile, so you could see some of that weakness reversed, but what we saw last week was good. So until further notice, we will assume that things are tracking as expected. So that saw yields down, it saw bond prices up, and the NZX investment grade corporate bond index had another positive week on the back of those moves, and it's returned 1.8% so far this year. So it's had a fairly good week. In terms of the key events from last week, the headline act was US inflation. This came out on Wednesday night, and markets were encouraged by a softer than expected print for May. And this was the second month in a row that we've seen the consumer price index, the CPI, rise by less than expected. The headline CPI for the month was actually unchanged, it didn't go up at all. And that is the lowest monthly reading that we've seen since July 2022, which is 22 months ago, so almost 2 years ago. That saw the annual headline inflation rate slow to a 3-month low of 3.3%. Markets were expecting to come in at 3.4. That would have been the same as last month, but it came down a little bit, came down to 3.3. The core CPI for the month rose 0.2%. That was below April ever so slightly, and that saw the annual increase in the core CPI slow to 3.4%. So that's down from the previous month. It was 3.6 the previous month, and at 3.4%, that's actually the lowest that we've seen in more than 3 years. You've got to go back to April 2021 to find a time when it was that low. So good news, and markets really liked that. We also saw later in the week the PPI come out. That's the producer price index as opposed to the consumer price index. And the PPI unexpectedly declined in May. It actually fell. So rather than just being flat, it actually did slip backwards a little bit. It was down 0.2%. That's the softest reading we've seen in 7 months. And some of the categories that feed into the PCE inflation report, I know there's a lot of acronyms here. The PCE inflation report, that stands for personal consumption expenditures. That's the Federal Reserve's preferred inflation measure. Some of the things in the PPI that feed into the PCE were weaker than expected. So, look, you put all that together, and it is good news because inflation is coming down a little more quickly than people thought. And when we look ahead to that PCE inflation report that will come out at the end of the month, and that's the one that the Fed is watching very closely, there is hope that it will be a little softer than expected too. So that was really important. And I think that was probably for me the key driver of markets being strong in the United States last week was that May inflation report. Shortly after that came out, this came out at about just after midnight, I think early Thursday morning, New Zealand time, and then several hours later, 6 a.m., you got the Federal Reserve decision, and they would have had a heads up about these figures. I don't think they would have moved the dial dramatically, but we did get the Fed decision, and then we got a press conference with Chair Powell, and we also got a new summary of economic projections, a new forecast set from the Fed. So this was a really important meeting too. They didn't change interest rates. They left the Fed funds rate at 5.5%. That's the highest in more than 2 decades. It's been there since July last year. But markets were very interested in that new forecast set, the first that we'd seen since mid-March. And in particular, markets wanted to see the number of rate cuts that the Fed was predicting over this balance of this calendar year. So back in March, the Fed was predicting 3. That's based on the median voter forecast, which is the closest we've got to a formal projection from the Federal Reserve. So 3 in March, and they've now cut that back to just 1. So they see just 1 cut this year, followed by 4 next year and another 5 beyond that. So when you look out over the next 2 or 3 years, they roughly see very much or very close to the same number of cuts, but they see those coming more slowly, less this year, and then they will catch up a little bit over the next year or two. So investors generally took the commentary positively, especially on the back of that inflation report. And when you look at the market pricing for what the Fed will do next, the market still sees 2 cuts this year. So they're a little bit more optimistic than the Fed itself is about the potential easing this year. There's 46 basis points of easing priced in. So that's almost 25 basis point rate cuts, 0.25% rate cuts. 1 basis point is 0.01%. So that's where markets are at. And in terms of the timing, pricing reflects a 68% likelihood of the first move coming in September, and then a cut is fully priced by November. So still debatable whether it's November, whether it's slightly earlier than that, but compared to where we were at a week ago, markets are more comfortable with the thought that the Fed will start to cut interest rates soon. So probably good news, because it could have gone the other way. You could have had a hotter than expected inflation report. You could have had some really tough talk from the Fed that would have seen markets push out those rate cut expectations, and that probably would have led to equity markets down and interest rates up. But you saw shares up and you saw yields down, so bonds are up too, and it was a pretty good week for investors on the back of those big developments in the United States. We also had a Bank of Japan meeting last week. This came late in the week, and while the BOJ didn't change its policy settings, it did signal a shift ahead. So its policy rate is sitting at a range of 0 to 0.1%, so ever so slightly in positive territory. Remember, we saw the first rate hike in 17 years back in March, and that ended 8 years of negative interest rates. So that was quite a milestone for the Bank of Japan. So they didn't move it up again. They left it be. But what they did say is that they will start reducing their purchases of JGBs, Japanese government bonds. And that will be another step towards policy normalization after that sort of first hike in 17 years. So they will formalize that strategy for trimming their JGB holdings at their next meeting, which I think is in late July, so about 6 weeks away. And that will essentially see it begin quantitative tightening, which is the opposite of quantitative easing, the opposite of QE. And that takes place after many years of expanding its balance sheet. Now it's going to be shrinking it. So the Bank of Japan will be hoping that this first step, or this next step away from stimulative monetary policy, will help support the currency, because the Japanese yen has been very weak. It actually hit a 34-year low against the US dollar back in April. So that has been a little bit problematic. So steady as she goes from the Bank of Japan, but we are sort of moving closer and closer to something that looks a little bit more normal. We've had a rate cut. The negative interest rates are now behind us, and we will see the QT begin later in the year. What to watch this week? Well, it is another busy week if we think about what we're going to see globally. First up, we've got retail sales out in the US this week. They're out on Thursday, so they will allow us to take the pulse of the US consumer, which is a very important part of the US economy and the global economy. We'll also get Chinese monthly activity indicators, retail sales as well, fixed asset investment, industrial production, unemployment. Get a whole bunch of monthly indicators out of China. That will be on Monday afternoon. I forget what time. It's usually about 3 o'clock or thereabouts. The biggest event or release, I should say, internationally on the economic front will be the global flash PMIs. And these will cover the month of June, and they will be out mostly on Friday, I think. The Aussie one is out at 11 o'clock on Friday. The Japanese one follows just after lunch, and then you get the UK, then Europe, then the US, all sort of through Friday evening. And these are something I watch really closely because they give you a very up-to-date read on the path of economic activity, how a business is feeling, what are inflation indicators doing, how are pricing intentions looking. So you learn a lot from the flash PMIs, and this will be one of the first indicators we'll get for the month of June. So looking forward to these on Friday. They've been pretty good in recent months. Last month, May, they pointed to an ongoing economic expansion in all the major regions. The global PMI, which is kind of all of them put together, that increased to 52.4. 50 is your break-even level. So 52.4, that's the 16th consecutive month that we've been above 50, and those figures from May were actually the highest we'd seen in a year. So the world is actually going okay from an economic activity perspective. There's obviously some parts of the world that are stronger than others, but on balance, we're not in terrible shape. Inflation indicators will be in focus this month. Last month, there was a bit of a mixed bag. US inflation indicators didn't look quite so good. We saw a bit of pressure there, but in Europe, they looked a lot better. And I guess that's one reason why the ECB in Europe, the European Central Bank, has been able to cut interest rates earlier than many others. So that is what we'll be watching internationally. We've also got a couple of big central bank decisions, not quite as big as the Bank of Japan or the Federal Reserve, obviously, but we will have monetary policy decisions that are coming out of Australia and the UK. So the Reserve Bank of Australia will be first. That's on Tuesday afternoon, 4:30 p.m. NZ time, and then you'll get the Bank of England at 11 o'clock p.m. on Thursday evening in New Zealand. So the RBA is expected to be on hold for much of this year. I think there is probably some chance of a cut very late in the year, maybe in December. But many people think it'll be a 2025 story. The RBA has a cash rate of 4.35, so that's the highest since 2011. But you have just seen a bit of persistence in terms of Australian inflation. So the thinking is that they will probably be one of the last of the big Western central banks to cut interest rates. But we'll be watching the statement, watching the commentary on Tuesday afternoon nonetheless. The Bank of England is likely to move earlier than the RBA. Pricing at the moment points to 50-50 chance of a move in August, and those odds rising to close to 100% by September. So they will be one of the next to move. They won't do it this week, but nonetheless, we will be interested in what they have to say on Thursday evening. Right, here in New Zealand, what's coming up? Quite a busy week, actually. We'll do this in chronological order. First up, Monday morning, 9 a.m., we'll get the latest Real Estate Institute housing market report. And I thought this was coming out last week. I was expecting it on Friday, but it's coming out on Monday. So I talked about this a week ago. I'll talk about it briefly again. This will cover the month of May, and it will really give us a bit more information about how the housing market is faring. In recent times, it's looked pretty sluggish. It's definitely lost some momentum since late last year. Volumes have been down. The days to sell has blown out a little bit, and prices slipped last month. Auckland slipped more significantly. So after we saw that big run up in prices in the 2 years leading up to late 2021, largely driven by very, very low interest rates, we saw house prices then fall from late 2021 till about May of last year. They fell about 18 odd percent. Then they stabilized. We saw a bit of a rebound. But in recent months, we've seen prices come back a little bit. And I think the housing market is still largely struggling. It very much is a mixed bag out there. But you've got high mortgage rates, you've got rising unemployment, you've got falling job security, you've got a sluggish economy, more than sluggish, you've got a recession, a mild one, but still a recession. So there's probably more headwinds than there is tailwinds for the housing market, and I can't see these figures looking particularly encouraging, which is not all bad. Affordability is still very low, and it's not a fantastic thing when you've got a housing market that is as expensive or arguably overvalued as New Zealand's housing market. So for buyers out there, and in the interests of affordability and so forth, it's probably not a bad thing if we have this period of sluggish prices that aren't rising. And then certainly if you're a first home buyer, it's not a bad environment if you're able to sort of get the funding and have the capital to buy a house. You probably have found yourselves in what's more of a buyer's market than a seller's market. So we'll get some fresh housing market stats on Monday morning. Wednesday, we'll get the results of another dairy auction. These will be out very early in the morning. A fortnight ago, we saw another rise, prices up 1.7%. That was the fifth gain in a row, and it was the biggest gain since early February. The GDT index is up almost 12% this year. It's at the highest level since late 2022. So the season has started well. Fonterra has provided an opening forecast of $8 for the season that's just started, the 2024-2025 season. That's better than last year. It will be the fourth highest in Fonterra's history. However, remember that costs have risen sharply in recent years too, whether it's input costs, whether it's wages, whether it's compliance costs. If you've got debt on your farm, then the interest bill has gone up, just like it has for all borrowers. So $8, probably pretty close to break even for the typical farmer. Maybe not quite break even if you're carrying a lot of debt. So it's good from the revenue perspective, but it certainly doesn't mean that the farming sector is doing as well as it has at times in the past. $8 is not what it used to be. But we'll get the results out of another auction early Wednesday morning, and hopefully they will look good again. And with a bit of luck, that $8 for this season will prove to be a bit conservative. It will be fantastic to see something closer to the mid-8s. Right, and then probably the main event in New Zealand will be the March quarter GDP report. So this will come out on Thursday morning, 10:45 a.m. A little bit dated. This covers January, February, March, and it's now late June. We're about to close off the June quarter, so sort of out of date, but it does get a lot of headlines and it is closely watched, and probably is quite important given the fact that our economy is at a bit of a crossroads. So you could see a market reaction if it's particularly strong or weak relative to expectations. Just to sort of recap, the December quarter, which was the last set of GDP figures we got, was pretty soft. It fell compared with expectations for a gain and expansion. And that was a fourth contraction that we've seen in the past 5 quarters. So it's been a pretty tough period for the New Zealand economy. We have been in recession, particularly when you consider the fact that we've seen very strong population growth. So when you add that into the mix, then you've got some quite severe weakness on a per person, per capita, per household basis, however you want to think about it. And that's why when you look at these official figures, remember that they are baking in that population growth, and things look even worse when you boil it down to sort of households, how they're doing, something more apples with apples. So it has been a very tough period. For the March quarter, not expected to be wonderful. The Reserve Bank is expecting an increase of 0.2%, which isn't much, although you've got a few economists out there that do see another contraction coming. I know Westpac is at least one of the teams that expects another decline. So that will be interesting to watch to see how it looks and to look at the detail. A weak result could firm up expectations for OCR cuts coming this year. At the moment, pricing points to about a 50-50 chance of a cut in October. And by the November meeting, a cut is fully priced. So in the eyes of financial markets, you're not going to have to wait till sometime in 2025, like the Reserve Bank and like a lot of the local economists are telling you. In the eyes of financial markets, by November, they'll be cutting, maybe even by October. And a weak economy is something that would fuel those sorts of thoughts. So this will be interesting to watch on Thursday morning, even though it is starting to get a little bit dated. So that's probably all we got. There's not much on the corporate front. Yeah, very quiet in terms of releases, so nothing to report there. I think it will be all about those global PMIs. That's what I'll be watching on an international front primarily, and here in New Zealand I'll be interested in that housing market report, but I think the GDP report will probably be the one that is front and centre, because that is the one that will really impact people's thinking about where the economy is at and going, and what the Reserve Bank might be doing over the coming months. So hope that's useful. Thank you for listening as always, and we'll talk again soon.
For more insights, visit craigsip.com.